In this free video course, you will learn everything you need to know about smart money concepts for trading stocks, crypto, forex, or any other financial market. By the end of this course, you will not only be able to trade smart money concepts correctly, but you will also learn about multiple smart money concept techniques that most traders don't know about. Alright, so let's begin here by talking about what you can expect to learn from this course. And the very first thing we need to cover is, of course, what is smart money concepts? Or in other words, what is SMC? In order to trade smart money concepts, it's of course very important to have a solid understanding of what it is in the first place. Next, we are gonna dive into some very important market structure concepts. We will learn about something called change of character, or for short, CHoCH, and we will also learn about something called break of structure, or for short, BOS. These two concepts are very important and they are fundamental to understand if you want to trade smart money concepts. In chapter 3, we will cover yet another important concept, and that is strong and weak price levels. Strong and weak price levels are very important when it comes to finding good entries and as a result, make better trades. Next up, we're going to talk about something called supply and demand. We will both take a look at the basics of supply and demand, but even more importantly, we will take a look at how you can use supply and demand together with market structure concepts such as strong and weak price levels, change of character, and break of structure. Because it's actually when you combine supply and demand with these other concepts, you can really start to improve your trading. In chapter 5, it's time to cover fair value gaps, or for short, FVG. This right here is a very important smart money concept to understand, and I will go over everything you need to know in a simple, step-by-step manner. Last but definitely not least, we are going to talk about liquidity grabs. This right here is one of my personal favorite concepts. And when you master it, you will both be able to take better trades, but you will also be able to avoid many of the false signals. But alright guys, so let's begin here by super quickly taking a look at what is smart money concepts, or SMC. And in very simple terms, smart money concepts are trading strategies used by the smart money. And what do we mean when we talk about smart money? Well, smart money are basically knowledgeable financial professionals. Like for example, banks such as Goldman Sachs or JP Morgan, hedge funds like for example Bridgewater. And that is why I have this image right here. Many of you guys are probably familiar with him. This right here is Ray Dalio, which is the founder of Bridgewater. And I actually think that Bridgewater is the largest hedge fund in the world. So Dalio and his hedge fund is a great example of smart money. But we also have other institutional investors, such as mutual funds or pension funds, that are definitely considered smart money. But now then, what are some important characteristics when it comes to smart money? Well, first of all, the most important characteristic here is that smart money have large amounts of capital. And because they have lots of money, they are capable of moving the market. So if we as smaller investors can understand how smart money moves market, we can trade in the same direction as the smart money, and as a result, make more profit. Another important characteristic here is that smart money often have access to more advanced market data. They often have more sophisticated analysis tools compared to retail traders like you and me. Smart money often also have, large teams of highly skilled analysts and traders. And that is of course yet another big advantage of the smart money. Alright, so now when we have a basic understanding of what smart money is and also what smart money concepts is, we are now ready to start learning about smart money concepts. And the very first thing we need to learn about here is something called market structure. So let's begin here by taking a look at some market structure basics. Market structure is basically the analysis of how the market has moved in the past to predict how the market will move in the future. And the first thing we have to learn here is that the market can be in 3 states. The first market state is the uptrend. And we know that the market is in an uptrend if the market consistently breaks higher highs while at the same time prints higher lows. So if you take a look right here, we can see an example of an uptrend. You can see that the market here is both printing consecutive higher highs while at the same time printing consecutive higher lows. As long as the market keeps on printing higher highs and higher lows, we are in an uptrend. And very soon we will dive deeper into analyzing uptrends. But so far, this is all you need to know. The next state the market can be in is a downtrend. And this is basically the opposite of the uptrend. So in order to have a downtrend, the market needs to consistently break to lower lows while at the same time staying above the highs. So right here, we have an example of a downtrend. As you can see, this market prints consecutive lower highs, while at the same time printing consecutive lower lows. And the final state a market can be in is a sideways market, or in other words, a trading range. And a trading range is very simple. That is a market that moves sideways without a clear uptrend or downtrend. So right here, we have an example of a sideways market. You can see in this case, we have the highs here at the same level and the lows at the same level. But a sideways market can also be a market that looks something like this. For example, right here, you can see that the market is printing higher highs, but it's also printing a lower low. And then it prints a lower highs and lows here at around the same level. So a trading range doesn't have to be perfectly straight with highs and lows at the same level. It can basically be any kind of market that are not in a clear uptrend or downtrend. And now let's take a look at the uptrend, downtrend, and sideways market a bit more in detail. Because this image I just recently showed you guys is actually a bit flawed. And let's begin here by analyzing the uptrend. Remember from earlier that in order to have an uptrend, we need to print higher highs and higher lows. And what we actually can see on this image is that we are printing a higher high right here, a higher high right here, but right here, this is yet another higher high. So the color of that circle should actually be a green one because we are still in an uptrend at this point. We can also see that we have a low, we have a higher low, but this right here is yet another higher low. So the market at this point in time is still in an uptrend. But now let's focus on this point right here. This is a very important point because this is the point where the market fails to break to a higher high. So at this point, we can consider that the market has entered a trading range. But one very important thing to consider about trading ranges is that trading ranges are actually very important to exist within uptrends. So it's very possible that we see an uptrend right here. Then for a short while, we see a trading range. We can call this a consolidation or a pullback. This right here is actually often just a pause in the uptrend. And many times after the trading range, the trend will continue in the same direction. Now, last but not least, let's consider when this market has actually entered a downtrend. Well, the first important signal actually comes when the price breaks below this point right here. Because when the price breaks below this point, we will for sure print another lower low. And this break right here is very important, and we will talk about that later on in this course. But for now, we just need to realize that when the price breaks below this point, we will for certain print a lower low. But remember here that in order to have a downtrend, we need to have both lower highs and lower lows. So it's not until we print this high right here that we actually have two lower highs and two lower lows. So it's basically at this point, the real sort of trend is confirmed. All right, so now when you know the basics about uptrends, downtrends, and sideways markets, now we are finally ready to take a look at change of character, or CHoCH, and break of structure, or BOS. And let's begin here by taking a look at break of structure. A break of structure occurs when the price breaks a higher high within an uptrend or a lower low within a downtrend. So for example, right here, you can see that this market is in an uptrend. And when the price pushes above this point right here, so at this point right here, the price breaks to a new high within an uptrend, and therefore this is a break of structure, or for short BOS. When we're talking about break of structures in uptrend, we can call this a bullish break of structure. And the same thing actually happens right here. You can see at this point, the price breaks to yet another higher high. So here we have yet another break of structure. But now, as you can see right here, this high actually never got broken. So we saw no more breaks of structure in this uptrend. Instead, let's focus on this low right here. When the price pushes below the most recent low in an uptrend, we call this a change of character, or for short CHoCH. And as we can hear on the name, a change of character basically means that the character of the price, which is currently in an uptrend, is changing. So a change of character is a first warning sign that the trend might be coming to an end. And now, as an exercise, I want you guys to try to find the first bearish break of structure on your own. So if you want to, feel free to pause the video right now and try to find the first bearish break of structure. Did you find it? Well, remember what a break of structure is. It's when we break highs in an uptrend or lows in a downtrend. And where in this downtrend did we break the first low? Well, we can see that the first low of the downtrend is right here. Remember that when we broke this low, this was actually a low in an uptrend, but the first break of a low in a downtrend was from this low, and it confirmed right here. So here we have the first bearish break of structure. The next bearish break of structure can be found right here. You can see at this point we broke to yet another low, so this right here is yet another bearish break of structure. But now then, what about this whole part right here? Here it gets a little bit complicated. But what we first can notice here is that when the price breaks this point right here, we actually have a change of character, right? Because in order to have a downtrend, we need to print lower highs and lower lows. And when we break this point right here, we are no longer printing lower highs. But the next move right here is more complicated, because you can see at this point, the price actually breaks to yet another low. Some traders will consider this yet another immediate change of character. And when we see two change of characters happening sort of immediately after each other, you can see here we have both higher highs and lower lows. At this point, we no longer consider the trend to be either in an uptrend or a downtrend anymore. And remember what that market state is called. It's called a sideways market or a trading range. So now let's dive a little bit deeper and take a look at something called internal and external break of structure and change of character. And here on the screen, we have two different time frames. The black line right here is the high time frame. So it could, for example, be a daily chart, or in other words, that every candlestick represents one day, while the red line right here is the low time frame. So this might, for example, be a 1 hour chart. And what's important to understand here is that change of character and break of structures are fractal, meaning that they appear on all time frames. And the break of structures and change of characters that happens on the high time frame, we usually call external break of structures. So for example, right here, you can see that we have a break of structure because the price breaks to a higher high. And since this happens on the high time frame, we can write E for external and then break of structure. Right here, we have yet another external break of structure, right? And for example, right here, we're seeing a change of character because the uptrend can no longer maintain higher lows. So we write an E for external and then change of character like this. But now, and this is very important, we also of course have break of structures and change of characters on the lower time frame as well. You can for example see that right here the low time frame breaks to a new high. So this is an internal, so I break of structure. Here we have another internal break of structure, and here we have another one. But what happens here? Well, at this point we can see that the low time frame can no longer maintain the uptrend. So here we have an internal change of character. And this internal change of character is the beginning of a short downtrend on the lower time frame. So one thing that you quickly will notice here is that upwards movements on the higher time frame will usually be large uptrends on the lower time frame. And moves that goes against the direction of the trend, like right here, will usually also be small trends on the lower time frame. And this process can go on and on and on. So let's, for example, imagine that we zoom in on this red move right here. If we zoom in even further, we will notice that this will actually look like a large trend on the even lower time frames. And we as traders can use multiple time frames at the same time to get better entries and exits in the market, and as a result, take better trades. Alright, so now when we have a deep understanding of change of character and break of structure, we are ready to take a look at yet another important market structure concept, and that is strong and weak levels. And this concept is something we will use throughout the whole course, so make sure to really pay attention now. The basics of this concept is very simple. A strong level is a level that comes from a move that breaks structure. And a weak level comes from a move that fails to break structure. So in order to find our strong and weak levels, we simply need to analyze the break of structure and change of character. And by this point, you already know how to do this. So for example, right here, we have a break of structure, right? And a strong level is a level that comes from the move that breaks structure. So what we need to look out for here is the beginning of the move that broke structure. And as we can see right here, this was the beginning of the move that broke structure. So this right here is a strong level. But what about this move right here? In order for this move to be strong, we actually need to break the previous low that is all the way down here. So this right here is a move that fails to break structure, or in other words, this is a weak level. And some traders will also call this right here a strong low because it comes from a low, and they will call this right here a weak high because this right here is a high. And for the same reason, this right here is yet another strong level or strong low because this move broke the previous high. And here we have another weak level because in order for this level to be strong, this move needs to push below this low right here. But what about this move then? Well, this right here is actually a strong level or a strong high. And why is this a strong high? Well, this move breaks the previous low. Remember, this right here is a change of character. And I see both levels that break structures and levels that break characters as strong levels. For the same reason, this right here is a strong high because it breaks the low. And this right here is a weak low or weak level because it fails to break above this point. And now you might of course wonder, why do we learn about strong and weak levels? Well, that will be very clear in the next chapter where we talk about supply and demand. Alright, so now the time has come to take a look at supply and demand. And this right here is a very important smart money concept that we actually can use together with what we learned just recently to create a trading strategy. But before we take a look at that, we need to of course learn the basics about supply and demand. So in simple terms, supply and demand is the force behind all price movements. In order for the price to go up, we need to have more demand than supply. And in order for the price to go down, we need to have more supply than demand. In smart money concepts trading, we identify areas on the chart where we see imbalances between the supply and demand. And these areas of imbalance are known as supply and demand zones. And why do we need to be able to identify supply and demand zones? Well, we can actually use these supply and demand zones to find entry levels in the market. So next, we will take a look at a step-by-step formula on how to identify supply and demand zones. And let's begin here by taking a look at how to identify smart money concepts demand zones. And the formula for this is pretty simple. Step number one here is that we need to find a strong momentum candle. And what is a momentum candle? Well, in simple terms, a momentum candle is a candlestick with a strong and sharp price movement. So as an example, this candle right here is a momentum candle. And to make this simple, what I'm looking out for when I'm looking out for momentum candles is that I want this candle to be at least twice the size compared to the real bodies of the previous candles. But preferably, I want this candle to be maybe 3 times or even 4 times as large as the previous candles. So what you can do here is that you can look at the previous 3 candles or so, and you compare the length of the momentum candle to the length of the previous candles right here. And you want to look out for a real body that is at least twice the size of these candles. And when you have found your momentum candle, step 2 here is to look at the candle before the momentum candle. So in this case, we want to look at this candle right here. Step number 3 is to draw a zone around the previous candle. And when it comes to drawing supply and demand zones, traders will always have different strategies and different methods on exactly how to draw these zones. But a straightforward and simple strategy here is to simply draw a zone around the previous candle. So what we want to do here is that we want to draw a zone from the highest point of the previous candle to the lowest point of the previous candle. So the length between these 2 points will be our demand. And this demand zone right here is a zone of imbalance where demand is greater than supply. Because in order to create such a large candle like right here, we need to see far more demand than supply. And the theory here goes that when the price eventually comes down and goes back to the demand area, since this have been a zone of imbalance in the past, we expect demand to come in at this area in the future as well and push the price up. Now let's also quickly take a look at how to identify smart money concept supply zones. And to do this, once again, the first step is to find a strong momentum candle. And as you guys can see right here, we have an example of a strong momentum candle. Why is this a momentum candle? Well, what we do is that we basically take a look at the previous candles, and we can clearly see here that the real body of this candle is much more than twice the size of the previous candles. In this case, it's maybe, 5 times as large, and this is a good sign of a momentum candle. The next step here is to look at the candle before it. And in this case, we actually have a special candle. This right here is what we call a doji candle. And by the way, guys, if you want to learn more about candlesticks and candlestick patterns, I actually have a full candlestick pattern trading course here on the channel. So if you guys have the time, I highly recommend to check that video out. I will make sure to leave a link up in the corner if you guys want to continue to improve your trading after this video. Step number 3 in this process is once again to draw a zone around the previous candle. And to keep it simple, what we want to do here is that we want to contain the whole previous candle. So we draw the zone from the highest point of that candle down to the lowest point of that candle. So this whole part right here will be our supply zone. And once again, the zone here is created from an imbalance between supply and demand, because in order to push the price this sharply and this fast to the downside, we need to see a strong imbalance between buyers and sellers. Alright, so now let's take a look at a real life example of a demand zone. So first of all, right here, we can notice a strong momentum candle. We can see that this candle is clearly more than twice the size compared to the previous ones. So what we do here is that we draw a demand zone containing the preceding candle. So we want to contain the wicks and the real body of that previous candle. And you can see that after this, the price went up. It pretty much traded sideways here for a while. But when it comes to trading, it's really important to be patient here, because eventually you can see that the price sharply went down to this demand area. We quickly touched the demand. And as the theory goes, because we had demand at this area in the past, it's likely that we see demand in the future. And after we touch the demand area, we can see that we saw lots of demand coming in and the price completely shot up. Later on in this video, we will take a look at exactly how you can combine this strategy with the market structure knowledge we learned about earlier. But for now, this is basically what we need to know. I also want to quickly show you guys an example of supply. And remember the formula here. The first step is to look for a strong momentum candle. And right here, we can indeed see a strong momentum candle. What we also can notice here is that this candle is clearly more than twice the size compared to the real body of the previous candles. In this case, it's maybe almost like 10 times as large. So here we have a very strong momentum candle indicating a strong imbalance between supply and demand. The next step here is to take a look at the candle that happened before the momentum candle. Then we drag a zone from the high to the low of this candle, and we drag the zone here to the left. So here we have our supply area, and once again we can see that the price went down here. We went up, almost touched the supply right here, as you can see, and on this point we actually saw a sharp movement towards the downside again. But once again the bulls managed to take control, and we actually quickly wicked above this area, and this right here was almost like a liquidity grab. And we will talk more about liquidity grabs later on in this video, because they can be super useful both to avoid false signals, but you can also use liquidity grabs to actually enter the market. But as you guys can see here, once the price, let me actually remove here so you can see. As you guys can see here, once the price reached the supply, we eventually saw lots of supply going in and the market completely collapsed. Alright, so now when we know about supply and demand, it's time to take a look at how we can find the best supply and demand zones. And to do this, we're actually going to combine two concepts. We are going to combine what we learned earlier in the video about market structure with supply and demand. So to repeat, market structure explains how and why the market moves, while supply and demand zones show imbalances in the market. So what we want to do here is that we want to combine market structure with supply and demand to identify higher quality zones. And now let's take a look at how to do that in a step-by-step manner. And let's begin here by taking a look at the high quality demand zones. To find these zones, what we are looking out for is strong lows. And remember from earlier in the video, the strong lows here are created from the move that breaks structure. So for example, right here we have a break of structure, which makes this low right here a strong low. So let's say we have a candle that looks something like this here, and then we see a strong green momentum candle like this. When we see this type of move happening at a strong low, we can draw out a high quality demand zone. And remember, we draw the zone from the highest point of the previous candle down to the lowest point. We want to include the wicks here, and then we drag out the zone to the right. So this right here is our demand, and what we're looking out for is that we want the price to come back down to this demand area. And because we saw demand coming in the past, or in other words, we saw an imbalance between demand and supply in the past, we expect demand to come in here in the future as well. And to confirm the entry signal right here, what I'm usually looking out for is some kind of candlestick pattern or another price action signal to confirm the entry. One important thing to notice here is that let's say that we found another demand area from this strong low right here. So this right here is another strong low because it caused a break of structure. One important thing to notice here is that the price will definitely not always go down all the way to the demand area. Many times the price will reverse before the demand area appears. And later on in this course, when we talk about fair value gaps, we will talk about how we can find good entry points even if the price doesn't hit our supply or demand. But now then, how do we find our high quality supply zones? Well, the principle here is pretty similar, but the opposite. So what we are looking out for now is actually strong highs. And remember, a strong high is a move that breaks structure. So for example, this move right here is not a strong high. Why is this not a strong high? Well, because the move from this point failed to break structure. Remember, in order to break structure, the price needs to push below this point right here. Once again, this right here is another weak high because this move failed to break this low right here. But if you take a look at the third high right here, we can see that this move actually managed to break the previous low, causing a change of character. And because this is a strong high, we can look out for a high quality supply zone at that area. So let's say we maybe had a candle that looked something like this at this point, and then we saw lots of supply coming in. So we have a red candle, strong red candle right here indicating supply. And remember how to draw our supply zone. We include the previous candle, we draw out the supply here to the right. And our goal here is to basically wait for the price to potentially come up to the supply area and then reverse to the downside. Once again, to justify a short position, I usually look out for some kind of signal coming in at this supply area. It can be a bearish candlestick pattern or simply a strong bearish momentum candle. But we want to see some kind of indication that we actually see supply coming in again at that area. So now let's take a look at a real life example of high quality demand. And as we can see on this chart, we had our first break of structure right here. So it's possible that we can find some demand at this low. But in this particular case, you can see that we had one candlestick right here. This was actually a bullish hammer, which on its own is a bullish reversal signal. So this right here was actually a potential trade. However, we can see that the next candle here was a green candle, but it wasn't really showing momentum. The third candle after this low was a strong momentum candle. So one could argue here that we could draw out a demand area from this candle right here. But the reason I did not choose to draw out this demand area, even though we actually saw a bounce, a beautiful bounce coming in at this level, the reason I did not draw out this demand area is that I prefer the demand to come in very near the low. So let's take a look at the second example. You can see that we had another break of structure right here. Beautiful break. We had a strong breakout candle above the break of structure, which is a good sign. We also had a sort of tiny liquidity grab here before the breakout appeared. But what I want to focus on is this area right here. So you can see that on this low, we saw a very strong momentum candle. This is an indication that we are seeing demand coming in. So as you guys know by now, what I did was that I took the previous candle and I draw out a demand area. And also remember here that before we can draw out this demand area, we need to see the break of structure, because if we don't see a break of structure, we don't know if this right here is a strong low. But after this break of structure, the price went up and printed a new high. It came down here, went up again, actually tested this high, and then eventually we fell down all the way here to the demand. And this took quite a few candles, and this is an important part when it comes to trading supply and demand, is that we need to be patient and wait for the price to come back down to the demand area before we take a potential entry. It's much better to be patient rather than to force trades. Forcing trades is never a good idea, and it will often lead to losses. But what we can see here is that when the price came down and tested the demand, we actually saw a bullish signal, because the price right here printed a bullish hammer. And from this point, the price just went straight up here, and we even caused another break of structure, which means that this uptrend continues. But now you might of course wonder, where do we enter? Where do we place our stop loss and target levels? And here there are quite a few different methods, but let's take a look at a very simple way of doing this. So the entry point is pretty straightforward. You can enter at the candle close of the candlestick pattern or candle that confirms the demand zone. As for your stop loss, one way to set it is to set it below the lowest point of the actual pattern, or another common method, and this is very common, is to set the stop loss just below the actual demand area. As for your target level, many traders will actually take a target above the break of structure, because when we are in an uptrend, the bias is that the uptrend will continue, or in other words, causing yet another break of structure. But what I like to do here is to actually take the target just below the high. And why do I do this? Well, the reason is that the previous high, and especially in this case when we have a sort of two clear touches on this resistance area, it's very possible that the price can actually reverse once again when we come up to this resistance. So especially in this case, it can make sense to take your target just before the resistance. So even if the price goes up and tests the resistance and then falls, we still lock in profit. Alright guys, so now it's finally time to take a look at fair value gaps, or for short, FVG. And what is a fair value gap? Well, fair value gaps, or FVGs, identify imbalances in the market. So this is pretty similar to the supply and demand. Remember, the supply and demand area is an area where we have an imbalance between supply and demand. And in simple terms, this is actually also true for fair value gaps. But how we identify the fair value gap is very different from supply and demand. So make sure to really pay attention. And fair value gaps works because large movements, or in other words, momentum candles, creates temporary market inefficiencies. And during these gaps, either buyers or sellers dominate the market. So we have a bullish fair value gap, and we also have a bearish fair value gap. And we will take a look at how to identify both of these types, of course, and how the traders use fair value gaps. Well, we use them as potential entry points, expecting the market to fill these gaps. So now let's take a look at how to identify fair value gaps. And first of all, we have two main types of fair value gaps. We have the bullish fair value gap, and we also have the bearish fair value gap. We also have lots of different variations of bullish and bearish fair value gaps, but the core principle for fair value gaps are the same. And here I feel like many traders sort of overcomplicate fair value gaps. And in many cases, this is a bit unnecessary because the core and the basics of fair value gaps is actually pretty simple. So let's start here by taking a look at how we can identify the bullish fair value gap. And the first thing we're looking out for when it comes to fair value gaps is that we want to see a strong momentum candle. And as a rule of thumb, we usually want this candle to be more than twice as large as the previous candles, or even larger, like 3 times or maybe even five times as large. In this case, you can see that this candle is almost 5 times as large as the previous one. The next step is to identify the candle before the momentum candle and the candle after the momentum candle. Then we draw a line here from the highest point of the preceding candle, and we draw a line here from the lowest point of the candle that comes after. And the distance between this point and this point is the fair value gap. And if the wicks of these candles was longer, let's say that this candle had a wick that looks something like this, and maybe this other candle had a wick that looks something like this, then our fair value gap would be between this point and this point, right? So this right here, this distance would be our fair value gap. And the same thing, but the opposite is true for the bearish fair value gap. We want to identify the momentum candle. We take a look at the candle before and after the momentum candle. And let's say that, for example, maybe this candle was all the way down here. Then our fair value gap would be from this point to this point. So now then, let's take a look at how we can use fair value gaps to find entry points in the market. And as you can see, right here we have an uptrend, and I already have multiple demand zones here on the chart. And the reason I have these demand zones is basically to demonstrate how fair value gaps are different from demand, because they can appear at other spots in the market. So remember here that in order to find a good demand or supply zone, we preferably want the demands to happen here at strong lows. But when it comes to fair value gaps, we can actually identify them in the middle of a move. When it comes to bullish fair value gaps, we still preferably want to find the gap here in a move that breaks structure. So for example, this move right here will break structure right here. So this is a break of structure. So preferably we want to find the fair value gap during this move. But the good thing here is that we can, for example, identify a fair value gap maybe right here. So this could be a fair value gap, or for short FVG. And what we are then looking out for is for the price to go up and come back down to test this fair value gap. Then we want to look out for some kind of bullish signal coming in at the fair value gap. And this right here can be a good entry point. So now let's take a look at an example of how we can use fair value gaps. And as you can see, already at this point right here, we have a pretty clear fair value gap. The reason for this is that we have a strong momentum candle right here. And we also have a gap between the lowest point of this candle and the highest point of this candle. So we can draw out our fair value gap zone just like this. And in this case, you can see that the price went up here. We came down, tested the fair value gap area, and then we pushed higher. However, as for entry points, I think that this one was kind of tricky to enter. One could argue here that you could enter on the candle close of this red candle because we saw a bounce from the fair value gap. But in this case, we didn't really see a clear signal on the fair value gap. So this is actually an example of a trade you might want to avoid. This was a bit 50-50 right here. But as we can see, the price eventually pushed above the break of structure here. So now we can once again look for good fair value gaps. And right here, you can see that we have a strong bullish candle. We also have some space from the highest point of this candle and the lowest point of the candle that comes after the gap. So here we have yet another fair value gap. The price went up here, created a high, came down and tested this gap multiple times. And here I want to pay extra attention to this candle right here. Because right here, we can see a very strong bullish hammer. And because we have a bullish signal, we can actually use this right here as an entry. We enter at the candle close of that hammer. As for your stop loss, in this case, it makes sense to place it just below this pattern, because this stop loss is both below the fair value gap and it's also below the pattern. For your target, you can either place it just below the break of structure here or just above. It's also possible to use a fixed risk to reward ratio. So you can measure this length right here, and using a 2-to-1, your target would probably be around here. And what is very interesting to notice here is that the price actually came up and we went down to actually test this fair value gap once again. And from this point, the price shot up and created a new break of structure. All right, so now let's take a look at the liquidity grab. This right here is one of my favorite smart money concepts because they can very often be great entry signals, and it's also pretty easy to, set your stop loss and target level from these liquidity grabs. But first of all, we need to know about something called liquidity zones. And liquidity zones are basically areas with a high concentration of orders. So these are areas on the chart where we, for example, have many stop loss orders or buy orders that are waiting to get triggered. And the theory here is that large players, aka smart money, often tries to push the price down or up to trigger these orders. And when these orders get triggered, this will create liquidity for the smart money. So for example, let's say that we have a very clear support level right here. And because we have a support level that is very clearly visible on the chart, it's likely that we have many stop loss orders placed just below this support. So smart money might push the price down in order to trigger these orders. This in turn will create more selling pressure, and smart money then uses the selling pressure to buy a lot at a cheap price. So this will in turn push the price up. And because the price broke the support right here, this will often lead to many traders actually entering a short position, betting that the market will continue to fall. And when you enter a short position, you place your stop loss above the current price. So now we might have many stop loss orders at this point. So you can see that when smart money pushes the price above once again, this can in turn trigger the newly created stop loss from the short traders and create even more buying pressure. So as I just explained, the market often reverses after the liquidity grab due to the temporary imbalance that is created. And we as traders can use these reversals as potential entry points. So right here we have a classic example of a liquidity grab. First of all, you can see that this market is in an uptrend. We're printing higher highs right here and higher lows. But at this point, we can actually see that we had a liquidity grab. And now you might of course wonder, when the price falls below this point, like we did right here, earlier in the video we have learned that this is actually a change of character. So why is this not a change of character? Well, for this, different traders will have different methods, but what I usually look out for and what I want to see when I see a liquidity grab is that I want to see a candlestick that wicks below the support or resistance and then very quickly pushes above. So we might, for example, have a hammer candle that looks like this. This right here is a clear indication of a liquidity grab. And this is also the reason why, in order to see a true change of character, what I'm looking out for here is that I want the candle to close below this low point right here. So in order to have a real change of character, I usually want to see price action that confirms the change of character. So it's very important to actually analyze the price action at these critical market structure points. And by the way, guys, if you want to learn more about price action, I actually have a full video course on the topic. So I will make sure to link that video up in the corner, and I highly recommend all of you guys to watch that video after you have seen this one. Alright, so now let's take a look at how to trade liquidity grabs. And the first thing we can notice about this chart is that we are in an uptrend because the price continues to break structure while at the same time maintaining the lows. Right here we printed a new high. But here, on this green candle, we can see something very interesting. We can see that the price quickly pushed above the resistance level we need to create yet another break of structure. But since the price pushed above and then immediately saw a sharp movement to the downside, this is actually an indication that we are seeing a liquidity grab. So here it's possible that smart money triggered multiple stop losses that is placed just above this high. Then they might have used this liquidity to buy a large position, and as a result, the traders that bought this breakout that is likely to place their stop loss orders below this point might in turn get triggered and lead to even more downward pressure. And one thing I really like about liquidity grabs is that it's pretty easy to manage risk and to enter around these liquidity grabs. So one of the most common way to enter is to simply enter at the candle close of the candle that caused the liquidity grab. The stop loss is usually placed above the highest point of this candle, because if the price pushes above, we have yet another break of structure, and this indicates a continuation of the uptrend. As for your target level, a common method is to use a simple risk to reward, so you can measure this length right here, and a risk to reward ratio of 2 would set your target around there. Alright guys, so this course is coming to an end very soon. But real quick, before we wrap up here, I want to thank you all so much for watching. And if you guys found any kind of help or value from this course, it would be super awesome and helpful if you can show that by dropping a like. By liking the video, you help out with the YouTube algorithm to push this video out to even more people. So I really do appreciate every single like. And also guys, of course, if you have any questions about this video, or if you have any suggestions on video topics you want to see in the future, please don't hesitate to leave a comment down below. I will try my very best to answer every single comment. And last but definitely not least, when you are ready to continue your trading journey, I highly recommend to check out this playlist right here. This playlist contains all of the educational trading courses I have made so far, and more is coming very soon. So yeah guys, I hope you all will have an amazing day, and I hope to see you guys in another video very soon. Take care, ciao.